Welcome to the Money and Wealth Show. Brought to you this week by AmericanManganeseInc.com. Always consult your investment professional before making any investment decision. The Money and Wealth Show is archived online at TalkDigitalNetwork.com. Here's Victor Adair.
We're in Vancouver today. It's late July 2012. The occasion is the Agora Conference. And with me right now, Marc Faber, the editor of the Gloom, Doom, and Boom report from Thailand. Marc, welcome to Vancouver.
Yes, thank you.
Nice to have you here.
Pleasure, my pleasure.
There's a lot going on in the markets these days. I mean, certainly we've got pressures or stresses in Europe. We've seen a number of European countries where interest rates on their government bonds have actually gone negative. Meanwhile, some of the weaker countries, their interest rates are going through the roof. What do you make of that?
Well, it's actually interesting that you're asking this, because a few years ago, a book was published with the title, "The World is Flat." And what we actually see is a world that isn't flat at all, in the sense that, as you pointed out, we have some countries where interest rates are negative and other countries where inflation-adjusted interest rates are negative, like the US. And then you have rising bond yields in countries like Spain and so forth. And you have other regions of the world that are still kind of in relatively healthy economic conditions, like Asia. And then you have countries in Europe that are moribund in terms of economic growth, where actually there is a recession. And then you have markets like the US that are still relatively elevated in terms of stocks, whereas in Spain, Italy, France, Greece anyway, the markets are actually below or close to the 2009 lows. So actually we have huge diverging performances in markets.
Okay, with diverging performance in markets, it seems to me that the credit markets are more worried about the future than the equity markets. Would you agree to that? Or is one right, one's wrong?
Well, in a way, the credit market, say US Treasury bond yields with the 10 years below 1.5% and so forth, they suggest deflation, whereas equity markets and some commodities like gold suggest rather inflation. So again, somebody is going to be wrong. But we have had bubble economies for the last 15 years. First the NASDAQ bubble, then the housing bubble, then we had the commodities bubble in 2008, then we have emerging markets bubbles and so forth. And in a bubble, everybody will be right and wrong at some point. In other words, the bulls on equities, they've been wrong essentially since 2007, but one day they'll be right. And the bears on bonds have been wrong, but at some stage they'll be right, because interest rates at some point in future will rise again. So this is a very challenging investment environment where you can't be overly dogmatic. In other words, from time to time you have to make major allocation shifts, or you take the view that we all don't know what the future will hold, and then you're more diversified with some money in gold and some money in bonds and some money in stocks and some money in real estate.
When we look at markets, we try to learn, maybe.
Yes.
So here's a bit of an anomaly. I understand that credit default swaps, in other words, the insurance cost with German bonds, even though German bond yields are negative, the credit default swap prices are rising.
Yes.
Can we learn something from that? What's going on?
Well, I mean, maybe the credit default swap market is an indicator of the future. And the difficulty today in markets is it's difficult enough to predict markets when they are perfect markets. In other words, in a market where no participant has a dominant position in the marketplace. But now we have government interventions. The German economy is an economy higher than $3 trillion. The EU is a $15 trillion economy. How do you want one country to bail out everybody else? This is not going to work. But the politicians who sit in Brussels and so forth, they may insist on more money printing, which doesn't really help. It may postpone the problem somewhat, but it doesn't help in the long run. And fiscally, the Germans, they cannot afford to help everybody. So, I mean, what we will eventually get are defaults, either through inflation, because too much money will be printed, or we will get defaults through actual defaults, where significant bond positions will have to be written off.
One of the expressions that our audience has heard me say before is that way more money has been borrowed than will ever be repaid. And there'll be consequences to this. When we look at, say, the euro right now trading at about 120 against the US dollar, in some ways, does it surprise you that it's as strong as it is? Would you have thought that it would have been weaker yet?
The US dollar, you mean?
No, I mean the euro. The euro relative to the US dollar.
Well, I mean, you see, 2 years ago in 2010, a book was published, Invest in Europe Now, by two well-known authors. And at that time, there was excessive optimism about Europe. And now there is maybe excessive pessimism. I've been buying some European stocks because they are down in some cases 90%. And when I compare their dividend yields to, say, bond yields and their price levels, I find them relatively attractive. Can they go down another 30-40%? Yes, easily. Can happen. But say if after the crash in 29 you bought stocks 1 year later, say 1930-31, because you took more losses until the bottom in 32, but it was still a reasonable buy from a longer term perspective. That's what I'm trying to explain is we have now these highly volatile markets. Say housing was a bad buy in 2007. Today, I think that US housing is a relatively interesting asset. Relatively. Because I can buy homes in Phoenix and in Atlanta for less than homes in Thailand. So on a relative basis, they are probably quite attractive. I don't want to live in Atlanta, and nor would I want to live in Phoenix. But if they are cheaper in these countries, in these states, than in, say, Thailand, it tells you something about the price level. So the euro was grossly overvalued when it was trading 1.5 years ago at 148 to the US dollar. Now it's probably about where it should be, but it can undershoot and go to parity easily. Can happen.
When I'm trying to figure out what to buy and sell in the market, or I say to myself, what am I trading these days?
Yes.
It seems like I'm trading political whim.
Yes, yes.
So it's so much the action in the market is a follow-on from what some politician said or didn't say.
Yes, for the time being and near term, political decisions affect market movements. But in the long run, it's the market forces that will prevail and overrun everything. So if you have money printing, yes, you can create additional bubbles like we created the NASDAQ bubble and then the housing bubble and so forth. But in the long run, the market forces will teach central banks a real lesson. That I assure you. Either you have rising asset prices like equities, you have some inflation in the system. What could also happen is that after this asset inflation we had over the last 20 or 30 years, which was very considerable, if you look at the price of paintings, at the prices of commodities, of collectibles and so forth, prices essentially of any kind of asset have gone up irregularly, but still they're up very substantially. And so at some stage, I think the deflation will be right, and we'll have a massive deflation. But the question is, does it come right now or from an elevated level? That we don't know. We just don't know.
So at the levels we're at now, we're end of July 2012. The stock market in the United States made an interesting low back at the beginning of June. Since then, the Dow has rallied about 1,000 points, maybe
Yes.
backed up a couple of hundred
Yes,
since
we're
then.
at 1266.
Yeah,
We rallied 100 points.
and we've got U.S. Treasury bond yields at more or less record lows.
Yes.
Do you like the American stock market at these levels?
Well, the US stock market is actually relative to other markets elevated because over the last, say, 12 to 15 months, it has grossly outperformed just about anything in the world, with the exception of maybe Thai, Indonesian, Malaysian, Singapore stocks, Philippine stocks. But other than that, if you look at European stocks compared to US stocks, then US stocks are up here and European stocks are down here. And I think if we look at the slowdown in the economy in China, at the recession in Europe, and at emerging economies that are no longer growing in general, and at the credit crisis, I think the US market is relatively high, in my view.
Yeah.
Now, if I compare the US market, say, Merck, Johnson & Johnson, and so forth, Procter & Gamble to US Treasury bond yields, I can tell you that US stocks are relatively low. So, you understand, it's a very difficult environment to be overly negative about US stocks and to be overly positive about US stocks. I think eventually you will be able to buy US stocks at a lower level than today. But I wouldn't go and now be heavily short the S&P 500 for the simple reason that we don't know how big further monetary accommodation will be. Independently whether Mr. Bernanke will be the independently whether Mr. Obama or Mr. Romney will be the next president, both will be money printers, believe me. And both will have fiscal deficits as far as the eye can see of above $1 trillion a year. That is an easy prediction to make.
So are U.S. Treasury bonds a long-term short then?
Long term, yes, for sure. But, you know, the NASDAQ was a very good short in December 99 and it still went up 30%. It was actually a good short already in August 99 and it doubled from August 99 to March 2000. So on the short side, you know, you have to have deep pockets or be patient. But for sure, in the long run, US Treasury yields will be higher than today. That undoubtedly. The question is, can they, say, on the 10 years rally further and yields fall to, say, 1% or not?
Yeah.
I wouldn't buy now long-term treasuries, but I can see why some people buy long-term treasury. Look, if you're the treasury of a large multinationals, and the corporate sector in the US has $2 trillion in cash, are you going to put all the cash with the banks that could fail? So you put it in treasuries, even treasury bills or treasury notes of 3 years duration or 5 years duration. You have a negative yield in real terms because you know that inflation is higher. I can give you so many examples where prices in New York, taxi fares have just gone up 17%. Disney tickets are up between 10 and 30%, and so forth and so on. So prices are going up, and you have, in real terms, inflation adjusted, a negative return on your treasuries. But I know that I will get the money back because the US can print money.
Sure.
So the return on my capital is guaranteed. It may be a bad investment, and the board of directors may say to you, you stupid treasurer, why do you put it in treasuries when we know that yields will go up? Then I'd say to you, well, if I had put it in the banks, maybe a bank would have failed. So this is the prudent way to invest my money. And equally, if you're a well-to-do individual and you have $1 billion to invest in equities, you don't know, maybe you lose 20%, maybe you lose nothing, maybe you make some money. In bonds, I own a lot of corporate bonds, but I look at them more like equities than bonds. They have an equity character. Like in 2008, equity prices slumped, but the lower quality bond market also slumped because spreads widened. And if you really want to be sure that you get your money back, you put it in US Treasuries.
Mark, one more question before you go.
Yes.
It seems as though there's a few main components of the worry factor in the markets right now. There's a slowdown in the American economy, certainly the European economy slowing down. There's the crisis in Europe. You live in Asia.
Yes.
It's so important what is going to develop in Asia. It's so hard for us out here to know what's going on over there. What's your take? Is China going to slow down at the same time as the rest of the world here and really make things tough, or do you see it differently?
Look, if you look at reliable statistics, say Taiwanese, South Korean export data, they're flat year on year. There's no growth. Who is the largest export market for these two countries? China. So you're telling me that China is growing at 7% per annum if electricity consumption is up 1% year on year, and so many indicators are down year on year in China? I tell you, the Chinese economy is not doing well at the present time. Is it growing at 3% or at 5% or at 0%? That I can't tell you. But the others, the super bulls on China, can't tell you either. All I can say is a friend of mine, he visits China, and he's done so for the last 30 years, 2 or 3 times a year. And he speaks to government officials and to the corporate sector, to people that buy copper and sell copper, that use steel and so forth. He is extremely well informed. And according to his research and interviews he had with businessmen, the economy is not doing well. I can tell you, in Asia, the economies are flat. They're not in a slump, because we had a very strong recovery between the bottom in 2009 and 2011. But we've gone at the high level of economic activity, ex-growth. And some sectors are turning down and others are still expanding, but by and large, ex-growth. And by the way, another reliable statistic are consumer price increases in Singapore. If Singapore has consumer price increases of 5%, I can tell you that in the US, inflation is also higher than what the Fed and the Bureau of Labor Statistics are publishing.
What does your information about China tell you about markets? What would you do in the markets knowing that?
I think you can safely assume that the global economy has decelerated meaningfully. In other words, in the US we have a slowdown, it's evident. We have even here in Vancouver a slowdown. It's flat, it's not growing at the present time. The mining sector obviously is not doing well, and because of the strong Canadian dollars, they have less tourists coming to Canada. And we have the Chinese economic slowdown that has a huge impact on other emerging economies, because China is the largest buyer of commodities from Brazil, from Australia, and so forth and so on. So once the Chinese economy has this kind of growth slowdown, that could actually lead to a more meaningful kind of a decline in the Chinese economy or a crash. In that scenario, corporate profits worldwide will disappoint. Worldwide. And by the way, you just have to look at the results of McDonald's in Asia. Their sales are not growing. This is a growth region of the world. If McDonald's sales in Asia are not growing, I can tell you that the Asian economies are not growing either. But will, because of that, stock markets plunge with zero interest rates? Maybe not. But I wouldn't be 100% invested in equities, nor would I be 100% invested in gold or 100% in treasury bonds. I would take a diversified approach and have a lot of cash. So if markets crash, maybe an opportunity to buy again at low valuations will occur.
Very clear advice. Dr. Marc Faber, I appreciate it. Thanks for taking the time to visit with us here in Vancouver
It's my
today.
pleasure. My pleasure.
Thank
Thank
you.
you. Thank you very much.
The Money and Wealth Show has been brought to you by AmericanManganeseInc.com.